Reliance climbs more than 2% after Macquarie upgrades the stock to outperform with a target of 1,500. The brokerage sees catalysts like better earnings momentum, potential geo-listing and gradual commission of new energy capacities as triggers. Kalpataru Projects climbs nearly 4% after the company's bagged orders worth nearly 2,300 crore rupees in the T&D business in the overseas market and building projects in India. Rights climbs about 3.5%, almost 4%. The company's received a letter of award from the South Central Railway worth 28 crore rupees. Importantly, the management tells CNBC-TV18 they're aiming to reach an order book of 10,000 crore rupees in the next 2 quarters. BEL, another stock which is up 2% after the company's seen additional orders worth nearly 600 crore rupees since Feb 20th. JP Morgan bullish on the stock with an overweight call. Hexaware slips on the back of a soft quarter. Constant currency revenue growth comes in at about 0.2% sequentially, while margins rise by 30 basis points. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. Markets doing well. We have Reliance, which is powering the Nifty ahead. But before we do that, let's go across to Money Control Global Wealth Summit 2025, where Mark Coombs, who's the CEO of Ashmore Group, joins in for a fireside chat on Trumponomics and all things India.
Dollars has moved out of Indian equities alone in the last 6 months. Now, we have a long structural story. There is certainty with respect to policy. Then why this level of exodus?
Yeah, because everybody's not a structural investor. Unfortunately, or fortunately, depending on how you want to look at it, India is regarded as up there as one of the most significant economies in the world in the future over the next 10, 20, 25 years. And it is a natural choice for big global investors to look for bigger markets to invest in. If we just leave the domestic side, the domestic investors out for the minute. So what happens is when people get excited, they look for a big market to play in. And if you think about it, what you're seeing now, the last 5 or 6 months of foreign capital disappearing from India, the equity market in particular, the daily traded equity market where they can change their minds, was really about 2 things. It was about, had India run too far, and based on very long-term numbers, you could say that the level of PE, et cetera, was high in terms of a 25, 30-year period where it should have been, particularly in the small and mid-cap space. But it was also people going, well, hang on a minute, I'm an emerging market investor with a global fund. It's about relative value. And China had been slammed for so long. And the big way we've outperformed in equities over the last 4 years, to be honest, was massively overweight India 3 or 4 years ago and underweight China. And a lot of global investors have switched that trade. They've said China is so cheap. The monetary policy bazooka in China was fired in September. They are getting serious about the fiscal. Eventually, you will get some level of growth coming back. If the state is underpinning property asset values by sucking them up from the private sector, you're hitting a floor. And once you do that, the chance of the natural demographic growth, which hasn't been great, comes back. China is just a whole hell of a lot cheaper, and India got so expensive in relative terms globally, not just against China. So there has been a lot of switching out of India into China. Not a lot of which is not permanent capital.
Okay. Now, a lot of money that has come into India, at least in terms of fund flows, I'm saying in terms of fund collections, has come through India dedicated funds, not through the emerging market funds, post-COVID at least. Now, do you see any time in future, now of course we are underway a fairly serious correction, at least if you just look at the post-COVID period, this is the first time we are seeing a more than 10-15% correction in the market. Do you see India becoming an asset class by itself? How far are we from that point?
Yeah, I do. I think that will definitely happen. All markets.
By when?
A week on Friday. I'll be here Thursday. I'll take the hat round, give me the money, we'll invest it, you'll do great. Which is a basic rule, of course.
No, on a serious note, like 3 years, 5 years, what would be your bet?
Well, I think it depends on your perspective. I mean, and a lot will depend on what happens geopolitically. And it's been very interesting seeing the evolution since 20 of how some of the larger institutional investors invest globally. It used to be when we went and spoke to the biggest investors, be they pension funds, be they sovereign wealth funds, they said, oh yeah, EM, I should buy that, here's some money. Or maybe I won't give you the money, I'll give it to some other idiot, but here's the money. They didn't really get into the nitty-gritty of what they were buying, and they just, we'll leave it to you to pick China over India, over Russia, over Brazil. And that was one of the biggest frustrations for my colleagues as we built local businesses, where our longer-term bet was two things would happen. The domestic markets would get much bigger, and that would drive the machine. But also global investors would start to say, I need to pick the winners. But while you had it's ironic that while you had all the benefits of globalization, you had a bit of a blurring at the edges of the foreign investor picking who to win. So yes, structurally investing in terms of manufacturing happens country by country, but the financial pool of capital tended to be, I just buy EM. So we spent 20 years trying to say to people, yeah, but there's a time you might want to buy Mexico and not Brazil, and a long time trying to persuade people to do that. The geopolitical stress of the last 3 or 4 years, ironically, has started some of the biggest investors thinking, wait a minute, I've got American pension funds are now asking us to pitch to manage money ex-China. We want EM ex-China. And as soon as they start thinking that way, that means that they start thinking, well, hang on, if I don't want China, maybe I do want something. And what we've seen over the last 18 months is we're having increasing conversations. We have an Indian team who are very good at what they do, and they're being asked to go and speak to the Americans, the Europeans, and those in Asia, talk about India-only money. And when people start thinking about India-only fund investing and India-only separate account investing, that immediately tells you you're getting to the point where you're a market of your own. Is it a black and white switch on, switch off? No. But is it happening over the next 5 to 10 years? Yeah, I think any serious global investor will have to have money in India, more or less, from 5 years' time, maybe from today. I mean, we do.
Right. Now, Indian markets have been actually the worst performer this year. Amongst emerging markets, I think it's the third worst. There was only, I think, Indonesia and Taiwan, which have lost about 11%. We've lost about 8%. Now, in one way, it is good because valuations become cheaper. A lot of the foreign investors who are probably waiting on the sidelines might want to get in. But how do you think realistically foreign investors look at this when you see this level of volatility?
How do I think they look at value here?
Yeah.
I think.
How do you view the volatility in India at this point in time?
Yeah, I think if I look at my fund managers who manage global books, it's quite interesting. You see a lot of investor psychology through the people you work with. I think they've all been looking for a moment to buy the market. I think they felt it's expensive, and they thought it was very expensive, and then they thought China was cheap, and so they reduced their massive overweight to India, and they started to buy China. At the same time, the institutions I mentioned before that are starting to look at single countries and trying to pick winners that have already started to pick India are saying, yes, it's all too expensive, but yes, I'm in here. And if my allocation is this, it goes up and down around the margin, but structurally I'm committed, even in liquid product. They're all looking at a chance to buy. I think they're saying, well, we're getting questions from the US through Europe, through Asia. Is it time to buy India now?
Right. I asked this question to Howard Marks also, and I'm going to ask this question again to you. What is your sense of, what are the chances that the US economy will actually slip into recession this year? Because government job cuts, potential inflation coming back, all of these look like not very happy things.
I think there's definitely a reasonable chance. Recession, obviously, depending on, let's say you define it as 2 negative quarters of growth, which is a traditional definition. That would be a lot. I think it's going to depend. This is what I talked about earlier about policy. If you have too much policy uncertainty, the first thing investors do is get out or do nothing or sit in cash. And there are a lot of investors in the US already sitting in cash, and there are a lot of foreign investors who say, I've got way too much US dollar. What on earth do I buy? Where do I go from here? And the longer policy uncertainty continues and people aren't sure of the direction, I think the chances are that the consumer in the US listens, hears and feels that, and then whether they're losing their job or not, they find the guy down the road lost their job, and they just do less. So the things to really look for are activity levels in terms of consumer construction and all that kind of stuff. You know, employment is really a lagging indicator for all of that. It's really what do you see in terms of the front end, in terms of what purchasing managers are thinking. All that kind of inflation, again, is a lag. It'll follow all of that. So I think there is a chance that there's already, the conversations we're having in the US at the minute, there's definitely, if you're talking to people in the Midwest, it's, well, I'm just going to wait and see what I do for now. And yeah, I had cash, and I was going to buy long bonds now because I thought duration rates were going to keep coming down. Maybe I'll just wait for the minute. So I think what you're getting is a little bit of a pause into, you had the election, this is a pro-business president, everything's going to be fabulous, markets went crazy, everybody bought AI, isn't that fabulous, the world's over changing, and now people go, oh, wait a second. And at the same time, you've got the suspicion that, like every other technology advance, the second level advance is to reduce the cost of it dramatically. So as the first producer, you make a lot of money initially, but then you have massive competition. Doesn't stop the adoption, it still becomes a widespread thing, but it gets steadily less profitable for the manufacturer. So where do I see that in terms of the US? Do I see recession? Probably not. But I think what we will probably not get is a lot more rate cuts, despite the fact there'll be massive political pressure. Because if you're the central bank, if you're the Fed, you should be taking a longer term view. And although the president might try and lean on you, this Fed president, he's got 18 months to go. He's going to try and do the right thing. So I think you're probably it's going to be a little bit wait and see. You might get one other cut. But then the real question is, do you get rate increases? And it's totally going to depend on inflation. But what I do think is the Fed will take a wait and see between 2 and 3% inflation. If inflation doesn't pop through 3% and get going, I think they're going to do nothing. And if it doesn't pop through 3%, I think they'll resist some kind of recession. And also, we just don't know how inflation these tariffs are going to be. There are tariffs that are not that inflationary. There are tariffs that will impact some countries, not others. Services tariffs are not there at the minute, which is a good thing for India. Services are a big deal for India, and tariffs are not there, which means the relative cost still stays pretty cheap. Also, India's producing some things that are pretty hard to tariff equal to start producing them in America. So there'll be winners and losers of the tariff stories. So I think recession is possible. I think it's not likely in the next 3 months. I think interest rates will sit in quite a narrow band.
Okay. What is your sense on fund flows into emerging markets? Do you see a huge reversal this year, or is that wishful thinking?
Well, what we saw from 22 was American capital panicking and hiding behind the sofa, so exiting pretty rapidly. So we saw a lot of negative flow, through 23, 24. That's slowed down quite dramatically. We're now seeing, as I say, people starting to say, is it time for me to buy emerging market equity and fixed income? Let me think about value. What supported that a little bit, which I think has slowed the flow down, is people just are so long the US. I mean, if they had a US equity position, shut their eyes, it went up 20% for a while. What's also supporting it a bit, I think, is they're seeing absolute performance is pretty good within EM equity and EM fixed income. I mean, EM fixed income was the best performing bond market the last 3 and 5 years, despite outflow. So I think we're seeing investors sort of take stock. If I look at our client base, our best clients have been with us a really long time, and they have a strategic allocation, and they bring it up and they bring it down. So they're nervous, they brought it all down tactically through 23, 24. So they're still in the game, but they're much smaller, and they're open to be reallocating to us. That's true in equity and in bonds. And if anything, the US is very much an equity market, so they prefer equities. So the first thing that will be a flavor of the turn from the US will be people buying equities. We're seeing a tiny, tiny bit of interest in the mutual fund space, particularly in things that are seen as friends, looking for single country product or for product where it's friend-shoring type story, not something that's seen as a competitor to the US.
Will it be necessary for Fed rates to come down for, a reverse flows to start to happen?
No, I don't think so. I think the key thing is positive spread.
It's just that it's perception.
I think it's a perception. I think what, again, like most things in life, when people feel there's some kind of floor or some kind of range that's established, then people start looking for the next place to go. Yeah, I mean, when everything's in one direction, people just tend to jump on the bus. But once things have settled down, people start looking backwards at numbers and start trying to look forwards. So I think we're in a position where we get a little bit of stability in terms of US policy, and people say, figure out, is geopolitics going to literally blow me up? If it isn't, then I can start investing properly. And as I say, in terms of flow, we saw big outflow in 23, less so in 24, less so now.
Sure. One last question. What's your take on...
All right, that's interesting commentary coming in from Ashmore. The most important headline from there is the fact that there is some money moving from India to China, and it's largely a tactical call, nothing permanent. So that's something we'll most definitely keep an eye out on. For our markets, extremely well bid right now, closer to 22,600, well bid by Reliance itself, which is up around 2.6%. Take a short break, come back, focus on markets here in India itself with the up move that we're seeing on the Nifty.
Well, Hexaware Technologies reported a soft set of numbers in the past quarter, but the company expects for the calendar year 2025, the performance to be resilient. We spoke to the management earlier today. They commented about the growth prospects. They also guided for better margins as well as recent deal wins will gradually get executed. Let's listen in to what they had to say.
Margins, you're right. We are going to be improving our margins very meaningfully from here. From a full year perspective, we reported a margin which was in the range of 15.9%. Operating margin EBITDA, we expect that to improve to 17% plus in 25, and it will further improve to 18.5 to 19% over the medium term of 3 to 4 years. Yeah, so it will start reflecting from April to June quarter onwards, so which is Q2 for us. So you'll see that the deals will start ramping up from a Q2 perspective, but the full impact of that will get reflected from Q3 onwards, which is in the second half.
Well, interesting commentary coming out there, but for the time being, the street is not buying into that dip. Hexaware is now down closer around 5%. But keep an eye out on the markets. We had an initial dip this morning. That's got bought into. Big boy Reliance Industries, that's doing bulk of the heavy lifting today. And both yesterday and today, it seems Reliance Industries has found its form. Technically as well, the stock has passed that crucial 20 DMA. For the time being, we slip into a short break. Come back, we'll continue to focus on markets as well as on stock-specific action. Stay with us.
Nifty Bank has moved into the red, so just keep an eye out on that. And the IT pack is actually, pressurizing the index from the top itself. But be that as it may, a couple of these urban consumption names doing extremely well, expected to improve from the first quarter of next year. We have Nestle, which has moved to the high point of trade. Avenue Supermarts as well, not doing particularly bad, has moved to the high point of trade as well. There you have Nestle, you'll have Avenue Supermarts as well. And we are seeing some pickup from the lows on Titagar Rail Systems as well. Now that stock has surged about 6%. Remember, it has corrected a goodish bit from the top itself. But let's get you some more ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins in with a stock.
Despite market volatility, Indian Energy Exchange stands strong with almost 84% market share in electricity trading, with the FY25 volume growth expected nearly at 25%. Of course, expansion into coal, carbon and gas trading, regulatory tailwinds, stocks should do well in the coming months. In December quarter, IEX delivered strong 15% growth in revenue and profits grew by almost 17%. During the quarter, IGX trading volumes nearly doubled and REC trading almost surged by 31%. In first 9 months, the company achieved almost 20% revenue growth and earnings grew by almost 23%. IEX expecting almost 25% volume growth in FY25, and the company anticipates introduction of India's first coal exchange in 2025 could provide new revenue stream. Of course, that will boost IEX's role in the energy sector. Its strategic shift into carbon credit trading, coal exchange, and hence real-time market participation should support higher growth. Its gas trading platform's strong performance indicates future potential, while rising green market activity, which is almost 300% up, is going to support renewable focus. The expected Q4 demand surge supported by weather patterns and rising industrial activity likely to support earnings in the coming months. Stock is trading at 26 times its FY27 estimated earnings, which is quite reasonable given the strong earnings outlook.
Thanks a lot for that, Jitendra. Well, and also we have some visuals that should be up for you on the screen of the new SEBI chief, Mr. Tuhin Kanta Pandey, who is up for you on the screen. And there's Network 18's Group Editor-in-Chief, Mr. Rahul Joshi as well. In a short while from now, the SEBI chair will be delivering the keynote address at the Money Control Global Wealth Summit 2025. Remember, this will be his first public address after taking office. So we'll keep an eye out on that, and we'll keep cutting into, that speech as well. Okay, all right. Well,